Welcome to the third video in our series 6 of the video tutorials on technical analysis. In this tutorial, we will be discussing about the types of chart patterns and how to use them in conducting technical analysis. Technical analysts who study chart patterns are also known as chartists. They work on identifying various chart pattern formations as trade signals. These chart patterns are created as a result of price movement of a financial instrument over a given period of time. They are formed by connecting different price points by means of trend lines, horizontal or vertical lines. There are various types of patterns and formations used for identifying a trend or a trend reversal. Here we have a list of some of the most commonly used chart patterns. These are head and shoulders, triangle formation, wedge formation, double top and double bottom, flag patterns, and the market gaps. In this video, we will be discussing the head and shoulder formation in detail. Head and shoulder formation is a trend reversal pattern. Once its formation is confirmed, it is followed by the reversal in price direction of the financial instrument in consideration. The components of this formation are the head, the two shoulders, that is the left shoulder and the right shoulder, a neckline and a trend line. The head and shoulder pattern, also known as the HNS pattern, is classified into two types, the head and shoulder top and the head and shoulder bottom. The head and shoulder pattern has a head and two shoulders formed as a result of a series of consecutive peaks and troughs. Consecutive rising peaks and troughs form the head and shoulder top, while consecutive falling peaks and troughs, that are also known as inverted peaks and troughs, form the head and shoulder bottom. The line joining the low of the left shoulder to the low of the right shoulder is known as the neckline, and the line joining the peak of the head of the HNS formation to the peak of the right shoulder is known as the trend line. We start with the head and shoulder top pattern. The head and shoulder top signals a trend reversal from buying towards selling. The first step in the formation of this pattern involves the formation of the left shoulder. The left shoulder is formed in continuation to an uptrend at its peak. It signals an end of an uptrend, and the price retraces towards lower price levels to complete the formation of the left shoulder. The next step involves the formation of the head of this pattern. The head is formed when the price trends back up towards higher price levels from the low of the left shoulder and makes a higher high. It then retraces back to form a low close to the low of the left shoulder. This completes the formation of the head. And finally, we have the formation of the right shoulder. The right shoulder is formed when the price again retraces back towards higher levels from the low of the head, making a new high. This high could be around the highs of either the left shoulder or could be lower. After making this high, retraces back towards the low, close to the low of the left shoulder and the head. Let's have a look at the trading platform to understand this better. We consider the example of the euro-dollar over the daily time frame. As you can see, this is what we spot as the head and shoulder top pattern. This is what we identify as the left shoulder. This is the highest point or the peak of the left shoulder. After making this peak, the price retraced back towards lower levels and then trended back again, making a higher high in the formation of the head. From this higher high, the price retraced back towards the lower levels at this point, completing the formation of this head. After the low at this point, The price again retraced towards higher price level, peaking at this point, which forms the peak of the right shoulder. As you can see, this high is lower than the high of the head, but higher than the high of the left shoulder. In some cases, the peak of the right shoulder could be at the same level as the peak of the left shoulder. From this peak of the right shoulder, the price again retraced back to complete the formation of the right shoulder, giving us the complete head and shoulder top formation. Once we have identified the head and shoulder top pattern, we need a confirmation of this formation before entering into a trade. We begin with identifying the neckline of this pattern. Once the head and the two shoulders have been identified, we draw the neckline for the head and shoulder top formation. The neckline is formed by joining the low of the left shoulder with the low of the right shoulder. Once the price of the financial instrument breaks below the neckline, it is considered as a confirmation of the head and shoulder top formation. The neckline thus acts as a support line as long as the price of the instrument is trading above it. Next we have the trend line. The trend line is formed by joining the peak of the head with the peak of the right shoulder. If the price takes support at the neckline and breaks above the trend line from below, then the head and shoulder top pattern no longer holds good and is considered to have been breached. If, however, the price breaks below the neckline, it will slide down to lower levels, at least up to the minimum objective of this pattern. This is the point where a trader using this pattern would sell the currency pair or the financial instrument in consideration. The minimum objective of the head and shoulder pattern is calculated as the perpendicular distance between the peak of the head and the neckline. This confirmation completes the head and shoulder top pattern, signaling a trend reversal from buying towards selling. Let's understand this through the trading platform itself. Getting back to our head and shoulder top pattern for the euro dollar, we now try to draw the neckline. The neckline is drawn by joining the low of the left shoulder to the low of the right shoulder. The trend line is formed by joining the peak of the head to the peak of the right shoulder. This neckline acts as the support line, while the trend line acts as the resistance. Once the price slides to lower levels after the formation of the right shoulder, if it breaks below the neckline, as at this point, it is considered to be a confirmation of the trend reversal from buying towards selling. So a trader would consider selling the euro dollar at this point. Alternatively, if instead of breaking below the neckline, if the price bounced back by taking support at the neckline and trended higher towards the trend line, breaking above it, then in this case, the head and shoulder top pattern would no longer hold good. Once the price breaches below the neckline considerably, then it is expected to slide down to the levels up to the minimum objective of this pattern. The minimum objective is the perpendicular distance between the peak of the head and the neckline. So the perpendicular distance between this point up to this point, as calculated in pips, would be the minimum distance that the price would slide down after breaching the neckline. Next we have the head and shoulder bottom formation. The head and shoulder bottom is just the inverted image of the head and shoulder top. It is formed in continuation to a downtrend and signals a trend reversal from selling towards buying. The first step involves the formation of the left shoulder. The left shoulder is formed in continuation to a downtrend at its low. It signals the end of the downtrend as the price retraces back from this low to make a new high. This completes the formation of the left shoulder. Next step involves the formation of the head. The head is formed when the price of the instrument trends back from the high of the left shoulder and makes a lower low. The price then retraces back to make another high close to the high of the left shoulder. Finally, we have the formation of the right shoulder. The right shoulder is formed when the price of the instrument retraces from the high of the head and makes a new low. This low should be higher than the low of the head, but could be at the same level as the low of the left shoulder. After this new low, the price again retraces back to form a new high close to the high of the left shoulder and the head. This completes the formation of the head and shoulder bottom pattern. Let's have a look on the trading platform to understand this better. We consider the example of the euro dollar again over the daily time frame somewhere in July 2012. You would notice the head and shoulder bottom formation at this point, which is towards the end of this downtrend. The left shoulder is formed in continuation to this downtrend with its low at this point. From this low, the price retraces towards higher levels, making a new high at this point. This marks the completion of the left shoulder. From this point, the price again slides towards lower price levels, making a lower low at this point. This marks the formation of the head. From this low, the price again trends up to a new high at this point. This completes the formation of the head. After making this high, the price once again slides to a lower level at this point for the formation of the right shoulder. This low, as you would notice, is higher than the low of the head, but lower than the low of the left shoulder. In some cases, this low could be at the same level as the low of the left shoulder. From this point, again, the price trends back up towards higher price levels, marking the completion of the right shoulder. Thus, we have the head and shoulder bottom formation completed at this point. Next, we draw the neckline and the trend line. The neckline is drawn joining the high of the left shoulder to the high of the right shoulder. And the trend line is formed by joining the low of the head to the low of the right shoulder. The neckline acts as the overhead resistance in this case, while the trend line acts as the underlying support. As you would notice, after the completion of the right shoulder, the price took resistance from the neckline and slid towards lower levels close to the trend line. If the price breached the trend line from above and slid to lower levels, the head and shoulder bottom pattern would no longer hold good. However, in this case, we see that the price took support at the trend line and bounced back towards higher levels close to the neckline once again. It again took resistance at the neckline and bounced back, this time a little higher than the trend line level. And finally, the price managed to break above the neckline at this point. Once the price broke above the neckline considerably, the pattern would be triggered and the trader would consider buying the underlying instrument, which is the euro dollar in our case. The price is expected to trend higher up to the minimum objective of this pattern. The minimum objective is the perpendicular distance between the head and the neckline. So over here, in this case, the head is formed at 1.20400, while the neckline corresponding to it is at 1.23569. So the difference between these two prices would give you the minimum objective. The minimum objective therefore comes out to be somewhere around 310 pips in this case. What this means is that once the price breaches the neckline from below, the price is expected to rise at least 300 pips above the neckline, which was the case as we can see here. The price rose from the level of 1.26396 to a high of 1.31750. So as we just observed on the trading platform, in the case of the head and shoulder bottom, the neckline is formed by joining the high of the left shoulder with the high of the right shoulder. Once the price breaks above the neckline, it is considered as the confirmation of the head and shoulder bottom. The neckline acts as a resistance line as long as the price of the instrument is trading below it. The trend line is formed by joining the low of the head with the low of the right shoulder. If the price takes resistance at the neckline and breaks below the trend line from above, then the head and shoulder bottom pattern is considered to have been breached and will no longer hold good. If, however, the price breaks above the neckline, it will trend up to the higher levels, at least up to the minimum objective of the pattern. Well, this is all about how we can use the head and shoulder chart pattern as a trade signal. We will be covering more chart patterns in the upcoming tutorials in this series. Thank you again for taking the time to watch this video.